We received the latest consumer price index inflation number out of the U.S. today. The CPI slowing for the first time in 6 months on the core side at 3.2%. For more on this and what it means for the Fed and the Bank of Canada and growth, et cetera, Kevin Khang, senior international economist at Vanguard, is here in studio. Hi, Kevin. Good to see you.
Thanks for having me. Good to see you, too.
So are we making too much of this CPI number? We got the markets up, a dollar down. What do you think of what you saw?
I don't think we're making too much of it. I think it's actually very consistent with the consensus that we're expecting. And that just means that we are continuing the gradual transition to the target. It's going to take some time, but it's encouraging because it's in the right direction.
So in the right direction, although since September it's been going in the wrong direction for the Fed. So do you have any sort of forecast as to how the rest of the year may play out?
Yeah, so quarter on quarter over the past year compared to the fourth quarter of 2023, if you compare those sort of a quarterly average numbers, because you don't want to compare just month over month or compare 2 points that's apart by a year. If you do that, we're basically at 2.9%, 2.8% year over year. And that's consistent with where we thought we would be by now. And then it's going to be a prolonged, gradual sort of travel to the 2% target. And then our view is that we may not reach that over the next year, but we're going to be headed in that direction.
Okay, you just told me you went to school in Canada, so you're familiar with Canada. Mm-hmm. So can I ask you about, well, I will ask you about the Federal Reserve's general policy and their rate trajectory, and then the Bank of Canada. There's a wide differential, as we know. Yeah. Can you compare and contrast the two?
So they shared a lot of commonalities in the beginning, especially during the sort of a liftoff and rate hiking period in 2023. But now we're actually sufficiently different in the sense that in the U.S., we're still growing at a very sort of high above trend rate, and you have a very strong job market. And that's sort of reflected in Fed's latest sort of statement in December, where they're saying that, we were going to remain cautious and we're going to see what happens, and then sort of basically be data dependent. And compare and contrast it with Bank of Canada, on the Canadian side, we maybe have a sort of a textbook case of monetary policy having worked a little too well. Through the variable mortgage sort of a system that you have here. And then as a result, probably Bank of Canada is probably a little more motivated and prepared to do everything in its power to make sure that we're continuing to support the aggregate demand.
Okay, Kevin, Vanguard has, as one of its tools, the so-called Vanguard megatrends model. You look at GDP, inflation, Fed policy, and then you tack on corporate valuations or stock valuations. So how does that work, and what are you looking for exactly?
So what we're looking for is actually, it's interesting, we're talking about sort of the monthly data releases and what does that mean for where the economy is going. But if you kind of take a step back and look at what's really driving the economic growth over not just month over month or quarter over quarter, but over a full year and then over a decade, it's really the supply side forces that are driving. So we've looked at the last 130 years through that lens. Not really focusing too much on the cyclical forces, but focusing on things like productivity growth, population growth, demographics, and things like the effect of debt. And having kind of looked at the decadal growth and market trajectory through that lens, we're basically coming to the view that the next decade will be really a tug of war between AI-driven productivity growth and then the debt and then sort of a structurally unfunded deficits that we will continue to have to run, and the amount of weight that's going to put on the economy.
And that's interesting. And you've brought us a couple of charts. We're going to get to these now. They have to do with U.S. exceptionalism and also the potential for any earnings growth in the United States. Can you run us through these?
Yeah, so the chart that we're looking at is basically kind of making the point that, it's just like compounding an investment in general, where year over year you may see a bit of a difference. But if that sort of a difference continues into a trend, then you actually start things changing by a meaningful amount. So what we're looking at here is that there seems to be a sort of a chasm that's turning into a slightly bigger difference between the U.S. and the rest of the developed markets in terms of the economic growth.
Right, and we don't like the look of Canadian productivity there, no big surprise.
Yeah.
And then the other chart about the earnings growth?
Well, the other chart about the earnings growth is that, so this is kind of what's been driving the U.S., very exciting U.S. equity markets, and especially their growth sector, growth equity sector versus everything else. And it turns out that it's really the sort of earnings growth and how much they've been able to grow both revenues and margin expansion, that then really generated the excitement to garner the support for the price earnings multiple expansion. You just didn't really see that in really sectors outside of infotech. And that's something that we are hoping that change over time, even as AI sort of driven productivity boost supports the economy forward. We're hoping that what we've been experiencing in the infotech sector actually broadens and just applies more towards the rest of the sectors.
Right.